When you sell a business, stock portfolio, or crypto, you trigger a capital gains tax. Avoiding it requires locking money in an illiquid structure. You generally have two choices. You can pay the IRS a portion of your profits immediately, or if the asset was real estate, you can use a 1031 exchange. A 1031 exchange lets you defer taxes by reinvesting proceeds into a similar property. The Opportunity Zone program offers a third option that covers any asset class. It allows you to protect profits from stocks or business sales, but requires a decade of illiquidity. This chart maps the trade-off. A standard brokerage account sits top left, highly liquid, highly taxed. A 1031 exchange sits near the middle, but Opportunity Zones sit in the bottom right, offering maximum tax efficiency in exchange for restricted liquidity. The choice is about whether your financial plan can survive parting with that capital for 10 years to secure the savings. In July 2025, the President signed the One Big Beautiful Bill Act. This legislation changed the eligibility and duration rules for the Opportunity Zone program. The law mandates a sunset for the current map of eligible zones at the end of 2026 and requires a new set of zones to be designated starting in January 2027. This rapid timeline creates a period of high uncertainty. Deploying capital into existing zones right now is extremely risky because those specific areas may not be included in the 2027 map. The regulations that governed the first phase of the program have changed. Investors must now navigate a specific 10-year timeline to capture the tax benefits. Unlike a 1031 exchange, where you must reinvest the entire sale proceeds, an Opportunity Zone requires you to roll over only the capital gain portion into a Qualified Opportunity Fund. A Qualified Opportunity Fund, or QOF, is a specialized investment vehicle set up as a partnership or corporation to invest in eligible zones. This allows you to keep your original principal liquid. If the QOF investment is held for 10 years, every dollar of capital appreciation on that new investment becomes tax-free. However, at the 5-year mark, the tax deferral on your original gain expires. You will owe taxes on those original profits before the fund investment itself pays out. You must have outside cash ready to pay the IRS at this point, as the money in the Opportunity Zone fund remains locked. Reaching the 10-year mark triggers a basis step-up to fair market value. A basis step-up is a tax rule that adjusts the cost of your asset to its current value, meaning your legal tax liability on the new growth drops to 0. The 0% final tax rate is real, but it requires surviving a midterm, out-of-pocket tax payment while your capital is illiquid. The OBBA directs financial incentives toward rural communities with populations under 50,000, rather than the urban areas favored under previous law. Investors who deploy into these specific rural zones receive a 30% reduction in their deferred tax liability. This is significantly higher than the 10% reduction offered for urban zones. This higher reward reflects a higher risk. Rural areas often lack the private investment momentum and demand that supported urban developments in the past. The law restricts previous broad incentives. For example, the 2017 provision designating nearly all of Puerto Rico as an Opportunity Zone is now significantly narrowed. The government is offering a 30% tax discount, but the investor takes on higher geographic and economic development risk to earn it. Maintaining the legal status of an Opportunity Zone fund requires navigating a strict compliance process with the IRS. The fund must pass a 90% asset test, proving that the vast majority of its holdings are in qualified property. It must also meet substantial improvement benchmarks for those properties. Missing that 90% threshold triggers monthly penalties tied to federal interest rates. The OBBBA also added reporting requirements. Funds must now submit annual data on local job creation and the number of residential units produced. A single administrative error can invalidate the tax shelter. This structure requires active professional management rather than passive oversight. If you are a real estate investor who relies on the flexibility to sell and reinvest every few years, you should avoid this program. These investors are better served by 1031 exchanges, which allow for indefinite tax deferral without a 10-year geographic lockup. If you value strategic flexibility, the Opportunity Zone program creates a geographic and financial lockup that outweighs the tax benefits. This program is designed for founders selling businesses or investors with stock and crypto gains. Since these assets are barred from 1031 exchanges, Opportunity Zones provide their only tax elimination path. It also benefits developers investing in rural communities for the 30% reduction. For investors with non-real estate gains who can weather a decade of illiquidity, the OBBA provides a path to compound wealth at a 0%